Right, Hamza, we are live.
Good stuff.
Okay, right. So we'll get started here. So thank you, Hamza, for joining us on the 10th episode of Let's Talk Startups in Africa, a speaker series that interviews entrepreneurs, investors, and ecosystem builders that are paving the way in Africa. And so just a quick housekeeping rules, how this conversation will go: about 45 minutes interview format, and then 15 minutes for Q&A from the audience. And just a little bit of more information about Africa Startup Lab. We are a nonprofit organization that offers startup support services to entrepreneurs, helping them move along their entrepreneurial journey. Types of programs that we offer, specifically high touch, low touch, mentorship, advisory, as well as workshops, trainings, and webinars. So without any further ado, welcome, Hamza. And if you could please start by introducing yourself to the audience here.
Thanks, man. It's a pleasure to be here, first of all, and so thanks for having me on here. We're super excited as ChanCap to be able to, have a voice on a platform like this. So pretty excited. So hey guys, Hamza Butt from Chandaria Capital. I'm the associate on the team. And very quickly, a background on Chandaria Capital. Chandaria Capital is the venture capital fund for the Chandaria Group of Companies, and the Chandaria Group of Companies is one of the largest family-owned conglomerates in East and Central Africa. And really, the fund was formed on the nexus of our managing partner Darshan's and his family's experience of being market operators in this region for almost 60 plus years, and then their desire to want to build back in the ecosystem and help entrepreneurs and help take advantage of all the great infrastructure that they felt was coming together at the right time. And so the fund was set up by Bruce, our principal, and Darshan and his brother Neer in 2017. I think it would have been 2017 or 2018, and we've been investing ever since. We are a early stage, so pre-series A, series A investor. We are sector agnostic. We invest in businesses that we believe can scale across the continent, businesses that we believe are led by strong entrepreneurs, businesses that demonstrate strong defensibility and that have demonstrated a good product market fit. We typically invest between 150,000 to about 500,000 USD per ticket per round. We tend to follow on. And, we really put a lot of emphasis and trust in entrepreneurs and the people that are building these businesses, because it's such a fundamental element within backing these businesses. So that's us. A little bit about myself. Born and raised in Kenya. I studied in the UK. I did my undergrad a while ago now. I did my undergrad in international business at the University of Kent. I then I was a little bit lost and was searching for way forward and stuff to do. So I ended up doing 2 masters back to back. I did one in international management at King's College, and then I did one at Cass Business School in energy trade and finance. Really thinking I was going to go down the energy route. But I think that was a really important degree for me, because when I came back to Kenya, it exposed me to venture capital, because at the time, everything energy related was renewable energy. And so subsequently, you're looking at all these really interesting startups, your M-Copas of the world and D-Lights of the world, and solar kiosks. So that's kind of what got me looking at startups in the venture capital space here, looking at funds that were investing at that space as well. But I kind of got itchy fingers. I really wanted to move, and ended up taking a consultancy gig at a group of healthcare companies, where I became the head of operations, where we were setting up 7 hospitals for them across the country. Oversaw setting up 2 of those, and I couldn't be in healthcare. I think it's a lot of credit and respect to people within the healthcare industry. It's a calling, and it's emotionally very tough. I didn't have what it took, so I stepped away, and I thought, it's so much fun being involved in building businesses from the ground up. And also with my previous background, I thought, venture would be a great place to be in. And so I joined the Chandaria Capital team, and I've been there ever since, and I love it very, very much.
Gotcha. Thank you for sharing that. Thank you for sharing that background there. So, and you've given us a little bit of your journey up until right now, working at Chandaria Capital. Can you tell us a little bit about, why VC, and how your experience has been so far working in VC?
Yeah, no, I think, like I said, when I came back from the UK, I thought I wanted to be in the oil and gas sector because it was very much what I had studied. There was elements to renewable energy at the time, but everything I was looking at the time, so this was in 2016, was about renewable energy. There was the huge Turkana wind farms coming up, and I had a great conversation with the team behind that. And at that point, I was like, oh wow, there's this huge venture thing happening here. Like people, there's funds, whether it was your DFIs or whether it was just energy specific funds. There was a lot of funds that were making these investments, and I just ended up speaking to these types of people in that process, and also to founders and entrepreneurs within the space. And then I ended up speaking to a really, really strong energy focused venture capital fund on the continent called Energy Access Ventures. I just knew one of the partners there, and we just had some great conversations about venture and what it looked like on the continent. And I thought, wow, this is pretty cool. So I tried to get into the renewable energy space. I thought it would have been great to leverage the fact that I had a very energy specific degree. And as I was waiting, I got a bit impatient. I have to be working. I just feel like the kind of like I'm just one of those kind of people who doesn't like to just be idle and a bit lost. So I ended up taking a job in healthcare. Uh, with a private again family owned company, and initially so they had a huge group, and the first of which was the family's first foray into healthcare many years ago. And so I joined initially as a consultant, and just getting my hands dirty with like operations and the ins and outs of businesses, and healthcare is difficult, right? And it's a very high touch industry, so there's a lot of like processes that can never be changed or can be changed, but it's a very painful process to change them. And one of the things that I was doing at that point was looking at a lot of technological solutions to try and make that process better, right? Make the customer journey better, increase our ability to offer good quality care. And fortunately, the family was a pretty open-minded family, and they were very supportive, and we explored a number of technologies, built in a number of features that weren't there before. We built with the IT team. That was a really fun process. And then from that, I started feeling drained by working in a hospital every day, seeing sick people every day, and I thought maybe it's time to leave. But again, had a conversation with the directors, and then they were like, "Look, we're setting up something else. Would you like to be involved in that? It'll be less straining emotionally on you, because you won't be in hospitals. You'll be setting up hospitals." And so I did that, and again, it was super fun. Trying to incorporate as much innovation from the beginning, right? So rather than bringing in solutions into these existing structures and systems where there was bound to be resistance, we were starting kind of like on a clean slate, and it was a lot of fun. It was challenging because we were not doing it in your Nairobi or Mombasa County. We were doing it we did one in Bungoma, we did one in Mandera, and these are really hard, or not remote, but yeah, probably remote is the right word to use, remote areas. And again, it was just like, this is a lot of fun. It's a lot of fun building companies and going through that. It was a lot of stress. But yeah, I think, we managed to set up the two hospitals, and I thought, look, I've given this a pretty fair go, and healthcare just wasn't for me in terms of being an operator myself. But I really enjoyed it. And fortunately, by then, there was again more that had happened within those years around innovation and venture capital and the startup scene in Kenya. I had really cool conversations with the people at Meta, and they started pointing me in the right direction. Esther, I don't know if she'll see this, but her and I had a very interesting conversation about venture and about what kind of stuff I should be looking at. And eventually I just found Chandaria Capital, and going through that whole process and understanding the pain points that businesses have, and the struggles that companies have in Kenya, or rather in Africa in general, in terms of setting up businesses, and the challenges that you face, and the very specific challenges that you face, was very exciting to try and be a part of the solutions, right? And also to be able to help people get access to that money. And so for me, my mind was made up. I had to be in venture capital, and fortunately, I'm in it. It's an industry that I love. I'm very happy doing this. So I think right choice.
So we had Maurice Otieno from
Yeah.
ex GM of Meta on the speaker
Yeah.
series, and yeah, he shared a lot of great insight around kind of like the Nairobi startups scene. So from your perspective, you've been with Chandaria almost close to 4 years now, but you've been within the tech and venture space in Nairobi and Kenya at large for more than that. How have you seen that space evolve over time? And in your opinion, what are the kind of defining characteristics that are kind of like that have changed, in the landscape and that make you even more so excited about being there?
It's a good question. I think the first thing and the most important thing that I've seen change is not just availability of solutions, but it's the information on the availability of solutions, right? Because I feel like, these solutions or innovations, people had probably been working on them in different ways and different forms for a while, right? But the information that existed surrounding these solutions or these innovations was like non-existent. If you wanted to get software for, your hospitals, you're contacting vendors in India, right? And you're like having these conversations with these guys and you're struggling to get these telemedicine solutions built in. And they're expensive and you're worried about like aftercare. Whereas now, you just have so many more solutions and maybe the solutions, okay, look, I know they were not always there, but the information that exists around the availability of these is great. I think, now we live in a place where you just do a quick Google search and you find like a bunch of solution providers here, or if you just have your ear to the ground, guys like Ilara Health are providing great solutions. Guys like Helium Health are providing great solutions. Guys like CarePay are providing great solutions within the healthcare space. And I think that if we had known this then, we could have probably incorporated these great solutions much earlier. But, so one thing that has definitely evolved is the information on the availability, right? Obviously, the availability is the basic one. And I think the availability of these solutions has obviously increased, but the information has been so great. We're fortunate that we live in Kenya in particular. It's a country that, in my opinion, at least with a younger generation, it's a young country, it's a young population. People want to include and adopt technology, especially new businesses want to try and adopt technology. And so that need and the preference to adopt technology is increasing. And luckily, the supply of these solutions is also beginning to match that demand, or vice versa. And that's again another one. And I just think very clever solutions, I think, and we're grateful and happy to be a part of, the building of these solutions. But I just think there's so many great solutions that people are building and making things so much better and so much easier. And so I think those are probably some of the main evolutions from my experience then to like my experience now in terms of like the technology availability and information around them.
Gotcha. Thank you very much for sharing that. So quick question though, are you as Chandaria invested in Ilara or Helium Health? Because that was a nice plug-in right there.
So we've invested in Ilara. We haven't invested in Helium, but and that's just proof of like, and even CarePay, we haven't invested in CarePay, but it's just that there are great innovations that now exist within the space that that are there solving really cool, solve very valid problems, and we're lucky that we can back some of them. I mean, it'll be impossible to talk about all the companies here solving things without mentioning some of our
obviously, it was a nice plug, man. I just wanted.
I have a list on my screen of just plugs. I don't.
I mean, it's cool if you do, man. We want to hear more. I think people that are following this, if they've not heard about these companies, even though, like you said, the information around the available solution has grown, it's good for them to find out about, what are the companies that are actually making moves on the continent. So that would be great. So just going a little bit more into your role as an associate at the venture firm, can you tell us a little bit about what your day-to-day consists of?
Yeah, I mean, so much, and at the same time, maybe too little. I don't know, but we source deals as a team. I think the great thing about our team at Chandaria Capital is I think it's less about your job is to do this and your job is to do that. I think we just work extremely well together. Everybody picks up work. Nobody's shy about picking up work, even the dirty or the non-glamorous stuff. nobody likes sending rejection emails out. We don't like doing that. And we always try and actually include some feedback when we do send that out. But, everybody wants to, I just think it's a culture that Bruce and Darshan in particular have fostered within us, that, just work and pick stuff up. So I'd say that as a team overall, I think we all look for deals together. We source deals together. We tap into our networks. We're speaking to different people about, what's good, what's not good. Then, we'll review deals at different points. We'll allocate X deal to Y person, and you then review, you go through the whole process, right? And then you go through your actual screening process of a deal. And so we'll do that. We all get involved in portfolio management. If our portfolio ever needs anything, they know where to reach us. And then we prioritize portfolio management. We want to help guys out. We want to make ourselves available, but also give them access to, like, one of the main selling points, which is the Chandaria group. So if that's something that's needed to be facilitated, like, provide them access to the sales team or the marketing team or the operations or the infrastructure teams, we make sure all of that is running pretty smoothly. So again, we'll be doing our portfolio management stuff. And then, towards the end and the latter stages, we start negotiating deals or reviewing documents that need to be reviewed, doing our due diligence. And then, once deals do reach a certain point, then obviously as a team, we start to sit down with the managing partner and be like, all right, this is what's going on. This is what we're looking at. And what are your thoughts? And then try and loop everything back into our review process, and then ultimately close deals, and then rinse and repeat.
Gotcha. And you mentioned Bruce. Shout out to Bruce. We met at a conference, I think about 2.5 years ago. Great conversation. And he actually is the one that was able to facilitate this conversation. So shout out to Bruce. And cool. So talking about your sourcing process, there is this thing that, VCs get an uncountable amount of emails and stuff like that. So tell us a little bit around, about how many, like, how do you source your deals, and maybe how many come through email? Like, how many emails do you kind of like check every day?
I mean, you'll have heard this from all the other VCs. Like you said, it's a lot. You'll get a lot of cold emails, some very basic email proposals, some just asking, how do I apply? Some asking, can I sit down and have a pitch with you? Some really, complex, good, deals that come through, like, they'll send you everything that they would need to send you, or that you would go back to them and ask them for. Some come from abroad. I mean, like, we have so many that come to us from markets that we don't typically invest in. So emails will always be, a place where we do get a lot of things from. So we try and manage that. We try and see how we can do that. We then also work really closely with just everybody in this, basically all the stakeholders. So we'll talk to our portfolio companies. We'll talk to other entrepreneurs who, even if we haven't invested in their companies, we'll form great relationships with them. And, everyone is just talking. Everyone wants to help. And I think that's just such a cool thing about, like, the venture space here, is that we've had situations where we've turned down a company, and rather than them being like, oh, you guys are the worst. I can't make everyone happy all the time though, but rather than you guys are the worst, they'll still send us great deals and be like, oh, I know this guy is doing really cool stuff. What do you think? And so obviously referrals through entrepreneurs is a great one as well, because entrepreneurs also are very closely knit together. So then again, we co-invest a lot. So we speak a lot to other funds, and we try and see what they're looking at, and we tell them what we're looking at, and then we look at those deals. And also, just generally keeping our ear to the ground and trying to hear about what's going on and what's good. And can't get everything, but we do try and be quite attentive to what's happening.
Yeah, and typically VCs will say warm intros are best. But for the entrepreneurs that might not have the network, or might not know somebody that knows somebody at Chandaria Capital, what do you think is the best outreach, or what would you suggest being the best outreach method? Do you prefer more detailed emails? Do you prefer shorter emails? Like what, in terms of maybe email or cold messaging on any other platform? What would be your recommendation to these entrepreneurs?
Our website is a great place. It's a good landing point. I mean, it tells you a lot about us, and it also then helps to filter out and help you out in terms of your own decision making. Like, is this a waste of time? Am I speaking to the right investors or not? Like, you could be pre-revenue, and our website states that we don't do pre-revenue. Typically, we don't do pre-revenue investments. But yeah, our website then has a submit your proposal feature on a contact page, which is a great tool powered by Parity. Again, another plug. But it's again a really great tool, which sorts our, not necessarily sorts, but like it receives the information, prepares it and consolidates it in a way that is very efficient for us. We'll then pop into like the dashboard and review everything and then respond accordingly. But that's probably the most efficient way if you wanted to do a cold email or something. I mean, you'd be able to get a lot of information about us, and similarly, you'd be able to get us the right information and efficiently. Like we could, rather than sending you back to the same link, if you were able to look at it and send it to us from there in the beginning, it could be helpful for everyone.
Gotcha. So just looking into, just double clicking into, your support to entrepreneurs and how you tap into, the resources of the Chandaria group. What specifically, what is the biggest kind of like asset that you think you bring to the table for any entrepreneur in terms of like value add to the entrepreneurs in your portfolio?
We like to break it down into like 3 or 4 main things. Like I said at the beginning, we're fortunate that we're such a large operating company, right? So at the very basic, at the most basic level, we can help you guys figure out, your general operations in the business and how to get certain things and processes right. So we tend to get involved in like, decisions on discussions rather on strategy and all that kind of stuff. And I think in some industries, we can add a lot of value in those conversations. So for example, in manufacturing or retail or distribution, I mean, that's the bread and butter of Chandaria Industries, which is just one of the companies from the group, right? So maybe just for a little bit more context, the Chandaria group is split into like a few verticals. There's Chandaria Industries, which is the largest paper, tissue, and hygiene manufacturer in the region. You then have Chandaria Ventures, which does more like joint venture, larger, more mature type investments into strategic companies, either along their value chain or to diversify their interests. So this has them exposure in financial services, but also within, their own supply chains and stuff like that, renewable energy as well. Chandaria Properties is a buys, sells, manages, and leases properties for them across the world, and then there's ourselves. So through all these different group companies, we're able to tap into expertise in different places, right? So for example, if we looked at somebody who wanted to do a neobank, or was building a neobanking solution, we could then provide them access to some of our partners within the financial services space, right? So to be able to help shape conversations and discussions around strategy, I think that's one. To give specific examples, with some of our portfolio companies that, rely heavily on distribution and effective distribution in retail spaces, for example, we've been able to have conversations and talk to them about the types of rates they should be charging, types of margins they've been looking at, how to be doing it most efficiently, what are the right ways, what are the wrong ways, all these kinds of things. That's one way. Similarly, like on some of the more specific ones, our engineering team are able to give great feedback on some of like the technologies that are being built, and they can say, okay, hey, look, I don't get value out of this as an end user. What if you did this instead, right? And then build solutions around that. So that's one way. So strategy is one way. A second way is networks. Networks is massive for us. We're able to provide access to our portfolio companies to a network of investors, portfolio companies. We can help with local stakeholder relationship management, that kind of stuff. We can help provide access to big customers or that kind of stuff. And I think that's a pretty important one. We help a lot in business development as well. So, providing connections or introductions to potential customers, providing references as well. We've done that in cases where we've given letters to potential customers for our own portfolio companies. Be like, hey, look, we're not just investors, but we're users. We believe in this. We believe in the technology. Try it out. Let us know. Happy to have any discussions. Get involved in that process. I think those, and then future fundraising is again another one that we really try and help out with. So we're fortunate that we have a great network of investors either side of where we play, guys who come in before us and guys who come in after us, and we can provide access to whoever at the right times.
Yeah, thank you very much for highlighting that. So I'd like to talk a little bit talk about the entrepreneurs that you actually invest into. the companies that you invest into. So walk us through, what you typically look for in a deal or in a company to say, hey, we're actually going to invest in this. You already mentioned that they'll typically have to be post revenue, but what other criteria do you look for?
Yeah. So I think, obviously you have to back the business model, right? Like you have to believe in the business model. And you have to believe that this is a defensible business model, one that can scale across the continent. I think that's one of the most fundamental things to us is, are we investing in businesses that we feel can scale across the continent? That's massive for us. We invest in businesses, like I said, that are defensible. Like there's a lot of innovation. There's a lot of similarities that you'll find within companies, but there need to be some barriers to entry, or there need to be some like key like competitive advantages, and that's something we typically tend to focus on and look at. The team is so important to us, so important to us. We feel that we've backed so far the right entrepreneurs within their relevant industries, or their respective industries rather, and spaces. So teams is huge to us. And product market fit is really important again, because there's a lot of businesses that we'd look at that have great concepts, but at the end of the day, there's just no PMF, right? So that's another one that's important to us.
Gotcha. So, and do you judge product market fit based on early revenues, or how far along do you require these businesses to be? Because I'd say you could debate that to a certain extent. Early revenue doesn't necessarily mean that there is product market fit. So how do you judge that?
Yeah, I agreed. And so I think, with product market fit, it's interesting because we can then look at, for example, like in SaaS solutions, how long have you had customers within your pilot period? How sticky have they been within this particular period of time? We would look at not necessarily revenue. Revenue would definitely be something we look at, because we wouldn't always do pre-revenue, and we very rarely, if ever, do pre-revenue. Paid pilots, we understand businesses can pivot so extremely from a paid pilot point of view to later on that is a completely different business model. But, when we look at it in terms of product market fit, we look at, okay, how many users do you have? What type of retention rates do you have? What type of churn rates do you have? Because that's a good indication in terms of like, are people satisfied with the product that they're using? Are people coming on? Are people reusing the product? That kind of stuff. And I think that's one of some of the metrics we definitely look at.
So now I'd like to talk a little bit about, your personal experience at investing, over the past 4 years. What are the biggest lessons that you've learned, being in this industry and supporting these entrepreneurs? I'm sure not all deals have gone as greatly as, you probably might have expected, but just tell us a little bit about the lesson learned and what you think might make for a successful VC and for being a great investor, especially in Nairobi and maybe Kenya and Africa at large.
Yeah, I think, and we spoke about this the first time you and I have had a chat. My main or my biggest learning and takeaway, and something that I really want to champion or really just put my weight behind, is patience. And patience is like not, oh yeah, it takes a super long time to do a deal. I'm not saying that. I'm saying that everybody needs to be patient with the industry and a sector as a whole, right? And it has so many implications across the board. It has patience. If you approach things, with patience, you can start your fundraising at the right time with enough cash left in the bank, so that this period is going to take a long time. Don't wait too late until you start raising money, because then things are just going to become difficult. You'll try and force investors. You try and force yourself into making bad decisions, taking bad deals. And on the flip side, venture is still so young on the continent, right? Like everybody wants to compare to Silicon Valley, and everybody wants to compare to like Southeast Asia or the European markets. And these are so much more mature than where we are, right? And I think just understanding that investors are still figuring out the space, figuring out the types of average return profiles they'd make, the types of businesses to back, the things to look out for. Founders are similarly finding out the same. They're like, okay, how to run a business efficiently within these places, how to work within all the market inefficiencies that exist within Africa. And so just being generally patient, and it has impacts on valuation. It has impact on the types of funders you're going to get money from. It has impact on the type of investments you're going to make. And the realism rather that needs to be applied. Really sorry about that.
No worries.
But yeah, it just has a huge impact in terms of the types of, sorry, just a second, guys, really sorry.
And we'll be right back after a short break.
Yeah, sorry about that.
No worries.
No, so yeah, patience is one thing for sure that we've learned, and just try and practice in general. Other learnings that we've had are, really like trust your gut, like for sure, like, sometimes if you feel like something is not right with the founding team, or there may be issues or dynamics that exist there that probably aren't going to be sustainable, like that probably will be the case. It compounds over time, friction compounds over time, erratic behavior compounds over time, and these things all have impacts in deals that we do or deals that we don't do, right? So I think that those are again some of the learnings for sure that we've had.
Yeah, I'd like to double click on the patience piece. So when COVID happened, a lot of VCs were mentioning that the pace at which deals were being closed was tremendously increased. Everything was virtual. You hop on a phone call on the Zoom, you pitch, and then you expect some form of investment decision in the following hours. Is that something that you've seen, during the climax of COVID? And if not, just describe to us like how COVID has kind of like changed or influenced the way you worked and supported entrepreneurs at Chandaria Capital.
I think good deals will always close faster. I think maybe these funds have just had the benefit of looking at really strong deals. Pre-COVID, we were so lucky we were able to close some deals, non-virtually or even virtually in 2 weeks. As a Pan-African investor, we've been using digital meetings and digital like due diligence and stuff pre-COVID. So the speed at which deals were being done at that time, again, varied in terms of the type of deal, the deal itself, the entrepreneur, many different factors, how quickly the round was closing, the dynamics around the round. Does the valuation make sense? If it does make sense, then we don't need to have a long drawn out, a negotiation process. So all these things are in there. I don't know whether I could say that COVID caused an exponential increase in it just because things moved digitally. I know so many other deals that was slowed down so much because of COVID, right? Because, investors could no longer go and do physical due diligence. Investors could never go, we've looked at stuff in the ag tech space, right? And businesses that still had a physical presence, that still had these farms, and you wanted to make sure that farm management was going okay. And, because of COVID, investors just couldn't go and look at these deals and make sure that things made sense. So in our opinion, or at least in my opinion, rather, I don't see that COVID was directly responsible for an increase in the speed, because it also had a decrease in the speed at which deals were done. But it's definitely made things a little bit more efficient. You save a lot more time. You're not traveling as much. You can look at deals differently. You're a lot more. You've been forced, or rather, you're forced to look at things a lot more specifically. So data rooms are standardizing a lot more. The requests around that is standardizing a lot more. So that kind of stuff is just becoming a lot easier for sure. And the accessibility of the information, like I said, you have your links, you just click on a link and you have everything you need on this company in just one place. DocuSign is a great technology, but it was there again before COVID. So it doesn't necessarily slow down the process of actually having to get your directors or your managing partners or your key decision makers to sign documents. So I think, I don't think, to your point about the relationship there, but I think in general, how COVID has affected, due diligence, I think in our experience, for sure, we've found that it wasn't a big shift because we were still making deals. So like we had done deals previously in Nigeria, we had done deals previously like in Rwanda, where we hadn't spent a lot of time on the ground doing our research. But again, it goes back to how much we collaborate with other funds and the due diligence the collaborative due diligence that we do with them there. But obviously at that time we were meeting the teams. We were able to at least meet teams a lot more in person and form relationships with them. That's been a big change. I think when you're effectively backing a relationship, like how much do I back this relationship? $500,000 is how much I value our relationship, more or less, right? Like you need to have a good relationship with the founders. You need to know, like, look, I trust you guys as a team to look after my 500K and grow it. So I think, you've been kind of like, I'd say that the intimacy of relationships has changed, and the intimacy around that has or rather the way that we've had to like adapt to that has definitely changed. And that's a big factor, especially in like, early stage investing, because you are putting a lot of weight behind the teams. So COVID has definitely affected that. Yeah, I don't want to ramble too much on the same point. I don't know if that answers your question.
It does. And you mentioned that, being able to evaluate team dynamics and if there are any types of kind of friction or kind of behavioral patterns that you believe are non-conducive to the sustainability of the business are part of how you decide whether to make a deal or not. And it seems like with the changing landscape post-COVID, those things might be harder to assess. Or do you think you'd be going back into trying to enforce meeting in person at least once before signing deals?
There's deals we have passed on purely because of not purely because of body language, but partly because of body language between founding team. Like you can just feel the friction between the two of them. You can feel that you can hear the difference in opinions for sure. But I think with videos turned off and people in different rooms in different countries, maybe it doesn't. You can't see the eyes. You just can't see it in the eyes. And we've had situations where like, we walked away from a deal because we thought founder dynamics weren't great. And then, you hear later on that, things just went crazy between the founders, where companies split up because of that, or the business failed because of completely different ideas on what the business should be like. And you could have just literally picked up on that through like a lunch with the guys or like, dinner or something. But I think, maybe those frictions won't necessarily be as in each other's face if people continue to work remotely, but I don't think that will work in startups. I think at the end of the day, if you have founders with two fundamentally different opinions or views on how the company should turn out, there'll be problems regardless.
Gotcha. And you mentioned realism in the VC space and just kind of like the trajectory. I would like for you to expand a little bit more, talking about how you see VC and investing in Africa evolving, and maybe where you've seen it be in the past, where it is now, and how you see it changing and evolving over time.
For sure. I think there's so many ways in which the space has evolved, and people who were probably in this space much earlier are really starting to see the benefits of it and feel the benefits of it. I think a really good example would be Flutterwave, right? Like it took Flutterwave much longer to hit unicorn valuation than maybe someone like Chipper Cash, but and that just shows the evolution, like the speed at which like unicorns are now being formed is much faster. I saw recently online that it took, I think, about 15 plus years for InterSwitch and Flutterwave to, not Flutterwave. Flutterwave was, I think, 5 years, sorry, to get to unicorn valuation or thereabouts. But companies like InterSwitch took much longer and stuff to actually hit these crazy valuations, and they showed patience. They didn't give up. They continued going at it. Cellulent is another good example. Like Cellulent took a long time to hit like good valuations. And I think that realism and that approach to like not give up and not think, my company needs to be valued at $100 million tomorrow or in next Series A or whatever. Like, I think that's one way. But I think to the point about realism, understanding what you're raising money for from the startup's perspective is super important, because when you're realistic about what you're raising money for, maybe you don't raise more money than you need, don't dilute more, or don't feel like you need to raise your valuation beyond a certain point to avoid that dilution. So, being realistic about the type of money that you're looking to raise, I think that discipline is so good, because it creates a situation where founding teams know that this is the exact amount I need. I don't need to, and if I'm disciplined with this, I don't need to raise my valuation beyond a certain point, because I don't want to be diluted, or the founders don't want to be diluted, as a result of that. And then that makes your conversations easier with founders, with investors. And then similarly on the investor side, like, you have to understand, like, it's hard work for founders. I mean, many investors get this anyways, they all know and have their own practices, but it's hard work for founders. It's a real challenge to raise capital. It's a real challenge to build businesses in all the market inefficiencies that exist. I mean, like, for founders in Africa, it's so crazy. Today, regulators can say one thing, and tomorrow it'll be the complete opposite. And for the founders who have got blood, sweat, and tears in the game, like, it's so tough for them, right? Like, there has to be a little bit of understanding on both sides and being realistic that, okay, things are super fluid here. There's so, you need to be agile on both sides, but the patience is super important. Like, it'll take us a long time before we start churning out unicorns like Southeast Asia or Silicon Valley, like, in the tens per year or more, or hundreds per year or whatever, but it'll take some time. And I think, we're starting to see that now, where in like the last 4 or 5 years, we've had, 3 or 4 unicorns, we've had more exits, and I think that realism and understanding that this still isn't an indication of what the market is like today. We still need to have more deals like this. There still need to be more success stories for the money to come. There still need to be more exits for investors to be like, oh, actually, hey, let's put our money behind these kinds of solutions. And yeah, so I think that realism is super important.
Yeah. So, and I'd love to double click on kind of like the conditions that need to prevail for, Africa to churn out more unicorns. And you alluded to some, but I'd like for you to share a little bit more about like what you think needs to happen for the pace of unicorn creation to increase further.
I think if we all knew the answer to that question, we'd
yeah, it's totally subjective, man.
Yeah, I mean, like, it depends. Honestly, it depends on so much. Africa is an interesting place because we talked about this previously, you and me, there are so many primary problems that need to be solved, right? Like, you need to solve so many basic problems before we start solving the complex problems, the easier to scale problems, right? Easier to scale means, like, you adopt technology, machine learning, AI, and you can really just scale it across, from an office in one town. But I think, and you can see it with almost all the tech businesses in Africa, there's no pure just tech, 100% tech, everything tech driven. Like, you still have so much of the human element just to make the things work. And, even in terms of like at the bottom of the pyramid, like when you're making sales and you're selling D2C or, selling to a specific type of customer, you always need human interaction, human touch. So that automatically slows the process at which you can, grow. So once you solve these primary problems, I think, Kenya is a good example. Like, just in general, broadly speaking, we've been able to build so many startups in different industries here across sectors. So not just fintech, right? You've been able to build fintech, logistics, manufacturing businesses, all on top of M-Pesa, right? M-Pesa was the primary problem that needed to be solved. There's this huge population that still remains unbanked. They don't have access to money. They don't have access to credit scores. They don't have access to technology, to banks and regular traditional systems. But through M-Pesa, they at least have somewhere to put their money, receive their money, and send their money from, right? Make payments, receive payments. And because of that, they were able to build on that. So that kind of goes to the point of, like, once we continue to build these primary problems, now we have to make that money accessible to everybody, right? Once we make money accessible to people, you increase their purchasing power. Once you increase their purchasing power, you can build different types of products on there that maybe today, or products that don't have a high elasticity, right? So, right now, people, insurance is another good example, right? Like, insurance in the West or in many other countries is like such a basic thing that people should have. But how do you convince, not poor people, but like, people who can't afford it, people who are, earning very little money every single day, how can you convince them to pay for insurance every year, never ever use that insurance, never claim it, and then next year pay again, right? Like, it's tough. It's a really tough sale. And insurance itself is an industry that's built on volume. So, you know what I mean? Like, so then it becomes like that specific sector or that specific industry relies on so many other primary problems to be resolved first. I think solving primary problems is probably, I think, the first and most basic thing. And we're fortunate that there's so many people who are solving these primary problems, right? Like, in different ways. So I think that's one thing. I think access to money is, again, obviously for now the solutions. For businesses, access to funding is really important. I think now there's a lot more money available for founders than there was 3 years ago, 5 years ago, and it'll continue to grow. But I think that touches on a very important point, which is like investor sophistication or investor education. We have a lot of wealthy Africans, like, who have been successful in their careers, or who have inherited a lot of money, or whatever they are, they have a lot of money, and everybody's used to investing in real estate, or agriculture, or the stock exchanges, or money markets. So getting them to understand that, hey, you could invest in this totally different asset class, like it's completely different. You can start investing in startups, and then these startups can generate returns at a much higher return rate than other stuff, and then getting them to see that. But then how do you get them to see that? You get them to see that through actual exits. Like, so many people can be like, yeah, my company grew in valuation from X to Y, but that's paper based. Like, until there's actually like no liquidation for investors in that process, you can't make a super strong case to be like, yeah, investors are making X amount of money. And then that now goes back to what's happening in terms of exits, like Stripe and Paystack. That's a good example to investors that actually, hey, look, you can make a lot of money. So again, getting the investors to think about it and getting them to like part with their money is great. And then I think by creating access to more angel investors, who then create a pipeline to institutional investors, who then create a pipeline to more like, growth stage investors, it's like a process, right? And it goes back to the patience thing. So all of this is like a gradual process. And I think some markets are way ahead. Nigeria, I think, is doing great stuff. I think they're quite ahead in terms of like, even just having angel investors, in terms of having people understand the space, in terms of having more exits to cross-reference, in terms of even having more founders putting their own money back into the ecosystem. So, I think that's, again, another thing that will lead to companies doing better. And then you'll start to attract the bigger funds. And when you start to attract the bigger funds, then you'll start to attract the bigger valuations, and then subsequently get to that. But one really important thing is regulation, right? Like the regulatory framework around everything. I mean, Africa is a big continent. Every country is super different. Politically, economically, regulators, a company could set up in Nigeria and look to scale to Kenya, but the regulation in Kenya is totally different to the regulation in Nigeria, that it makes it impossible, to scale here. But they've already saturated their captive market in Nigeria. So what are they coming, how are they scaling, right? Like, where are they scaling? How are they getting to these increased valuations? And when the one main bottleneck is just, regulation, it's not necessarily like prohibitive regulation, it's just unpredictable regulation, or old regulation that needs to be changed, and all of these things that need to happen. So those are some of the main things I think that are needed to facilitate the growth of these unicorns. But not even unicorns, companies in the $100 million range plus. I think it'd be great to see more of those as well.
Yeah, absolutely. And I was waiting for you to say regulation, and you finally got to it. So I'd love to go into that.
Best for us.
We love our regulators, but
we do.
But here, so what do you think, the ecosystem could do to shift regulation forward, or what are the examples maybe that you might have experienced already as to how regulators could be swayed and convinced to have more growth friendly laws and regulations that would allow for businesses to evolve and emerge?
I think this just touches on just generally the political climate in Africa as a whole, right? I think just more transparency across the board, from startups, more transparency, from the government, more transparency, from just all the stakeholders, more transparency. I think the more transparency that exists, the easier it then becomes to understand what everybody wants and what everybody would like to achieve or get out of those particular sectors or industries, right? I think, lending and fintech is probably the one sector that's most culpable to or sensitive to regulatory unpredictability, right? Like, regulators today can say, fine, you don't need a license to be a neobank. And then tomorrow, for whatever reason, they'll say, no, you know what, you need a license. I'm sorry, fine. Even though you're not taking deposits, you're not holding deposits. Maybe for some reason they might say tomorrow, you need one. Then the company needs to go and buy a license and whatever. But so I think transparency and knowing all along, like, this is what is required to do what it is I want to do. No problem. How do I get it? No problem. That transparency, I think, would be great. And I think to be able to reach that transparency, I think dialogue is super important. I think, and I can't speak for every country on the continent, but I know that in Kenya, in different sectors, they've formed sandboxes where you have your regulators speaking to your stakeholders, your customers, your startups and everyone, to try and actually create these frameworks that work for everybody, right? Because that's what it's going to take. It's going to take everybody sitting on a table and being like, this is what's working, this is what's not working, this is ethical, this is not ethical, this is outdated, needs to be updated. And I think those conversations need to be spread out more. They need to be had more regularly and then acted on. I think with anything government related anywhere in the world, bureaucracy, things slow down, things get tied up in red tape, and I think if everybody's on the same page towards actioning these changes or these conversations, I think it'll be in everybody's interest.
Gotcha.
You create more jobs, you create more wealth, you increase, you make it a better place to live overall. Nobody is doing what they're doing to make Africa a less livable place. People want to make it a better place for everybody. You want to increase education, want to increase healthcare, want to increase access to capital, want to increase, just general stuff that needs solving. So people want to solve real problems that have affected them and their families and everybody for so long. And so I think we just need to create a situation where there's just more dialogue and then action on the dialogue. Fundamental is the action part.
Gotcha. I'd love to, you mentioned something about investor sophistication and building strong angel networks that would kind of give those initial checks to these businesses and create a pipeline for institutional capital like yourself. What are the factors that you think would drive to the creation of these angel networks, and especially also better investor education? Because I would say for yourself, you've, by being an investment professional, this is your day to day. You've built some heuristics, rule of thumbs, and methods and processes that make you comfortable or uncomfortable in investing into a deal. And for the maybe average angel, or the people that are not familiar with angel investing or have not gotten into angel investing, part of it is maybe they don't have these techniques and heuristics that you might have. So how do you think that knowledge could, kind of trickle down to the people that are not currently investing?
Yeah, I think, great question. First of all, it's important to understand that there are people with money to do this, for sure. It's just they don't know how to do it, like you're saying. It's not that they don't want to, it's they don't know how to, and they don't know about it. They've not automatically written it off in advance. And the Chandaria Capital is a great example of that. I think, they're a big family conglomerate. They have been operators in the market for a long time, run successful businesses. And then, you have Darshan and his brother Neer, who come back, and they're the third generation entrepreneurs of the family. And, they've been abroad, they've studied, they've been exposed to all of this stuff. And they come back and they're like, what, this is a great way to not just help. We can help, companies build solutions and leverage, because I think one of the things that's been at the heart of what Chandaria Capital does is to be able to leverage our network and to be able to leverage our infrastructure. I think that's been from the beginning what Darshan and the family have always wanted to do. So there've been people like that. And so guys like Darshan and Neer coming back with that exposure, with that mindset to come back and then maybe talk to some of the older generation and be like, hey guys, I think this is what we're doing. This is a great opportunity to help, a great opportunity to make money, and also a great opportunity to change everything that's happening around us in the place that we live. So I think that's one way. I think definitely with returning, younger generations, that's definitely going to lead to conversations with the older generations who ultimately, how family businesses are or how old money is. It needs a push. Another way is, just and now it's super available. Like there's no murkiness or cloudiness around exits. Like we know about the Stripe and the Paystack exit. We know about how companies are exiting. You know, we know about companies like what are these guys called? The ones in South Africa. Get Smarter, you know, guys like Get Smarter who exited, you know, Fundamo, you know, people like this who have all had exits. And I think, you know, to be able to know that there have been buyouts where investors have been able to be bought out and made a good amount of money on that, I think that's great. I think the more exits that there are and the more knowledge that's shared about the exits and the potential types of returns on these exits will encourage more investors to put their money into the space. Jumia is a good example. Jumia listed. I think there was a lot of news around Jumia. People now understand that, you know, that's a route for companies to actually get to. And, you know, I think in general, the world understands more and more around growth stocks. The world understands, you know, that you don't necessarily need to just invest in profitable companies to make money. Although, you know, dividends are still there and you can still invest in that. It's about risk appetite. So I think with older generations, I think it's going to be really important for them to understand that, you know, your money will generate you great returns. There are ways to make it less risky, and ways to make it less risky is, you know, to do your diligence, take your time, hire people, you know, or trust the right people, co-invest, perhaps co-investing, you know, like with, so hypothetically, you know, we've seen deals where other high net worth individuals want to do or participate in deals that we are doing. Because they trust Darshan and his family, and you know, they come in and they trust our research on the findings and everything. So that's another example. You know, so co-investing is another one. A really important one goes back to regulation. I think more investors will invest when there's more certainty around taxation and the type of stuff that happens around that. You know, if I make investments in this, how will I be taxed? Am I going to be taxed CGT? Am I going to be taxed income tax? Do I need to incorporate a company abroad to do it? You know, things that make it uncomfortable, people will just stay away from it. So, you know, maybe alleviating that particular problem would be great. And I think, you know, just, well, and I think, you know, you're seeing now also another interesting thing is the more successful founders we have and the more successful companies we have, those founders are writing angel checks left, right, and center because they know the pain points, they know what to back, they know who to back, they know what solutions to back as well. So I think that's really important. You know, you're now starting to see a cycle where founders get money from investors then put money back into the fund. It's just a cycle, and I think that's a great that's again another great way forward, is to keep an eye on these angel investors doing their things.
Gotcha. And I'd like to use the last few minutes that we have to touch on a few quick things. So if I got it right, Chandaria Capital doesn't only invest in tech, correct? Or is it?
Yeah. We don't just invest in tech, we're sector agnostic. And again, part of the reason why we're able to do that is because we're a manufacturing company. And, you know, to invest in a company like Savannah Brands, who was a, you know, food and beverage manufacturer at the time of our investment into them, and now they're a beverage manufacturer. You know, we were only able to do that because we had that flexibility. We understood from the beginning that, you know, there are still primary problems that need to be solved. And not everything is solved by tech, right?
Right.
You can still invest in solid brick and mortar businesses that can grow to a certain point, and that all just ties back into like your, you know, targeted return profiles and all that kind of stuff. But for sure you can invest. I mean, if you think about going back to my first point to you, our previous point to you about primary problems, you know, understanding that, you know, access to food is a really important problem that needs to be solved, right? And you know, food can be done through manufacturing. So are we only going to invest in companies that are distributing food? Are we also going to invest in companies that are manufacturing food?
Right. And the question that I had there was, do you see any differences around investor appetite or capital availability between tech businesses, you know, and kind of like more traditional, like manufacturing, agriculture, logistic type businesses for investing across the spectrum, right? Like maybe if you're co-investing with other people, you're trying to get other people into a deal that you're leading, for example, do you see like a difference in appetite for the tech businesses that you are investing in versus the more traditional industries like manufacturing, agriculture, and logistics that you are also investing in?
Yeah, I'll get to that in a second. Just give me a second.
Yeah, for sure. Please.
Sorry.
and we'll be back after another short commercial break.
We'll be back after short commercial. But the subtitles still read that, so that's pretty funny. So yeah, the commercial is by Velvex tissue paper. Great tissue paper. No, so to that point, I think for sure, there's a difference in terms of availability for money for tech businesses and non-tech businesses. That's for sure, and that's not necessarily, it's not a fault of anybody. I think, when international funds got their money together, they thought about scale, and they thought about how can we get, this solution to as many people as possible in technologies, right? So one thing that we've seen evolve was tech businesses, or funds that invested in technology businesses, to funds that invest in tech enabled businesses. There's a difference, right? So I think, there's been that understanding or that learning already. Funds, for example, that look at the agriculture space, know there's no pure ag tech. You can't just start investing in, solutions that are building smart contracts that are going to trace where your cabbages come from. It's difficult. You can't start just investing in blockchain technologies that's going to trace where every single grain of soil. It's hard. You still have to invest in the land. You have to invest in the farmer. You have to invest in the working capital for the farmers. You have to invest in in machine and asset leasing, right? For you to be able to build agriculture businesses. So we're now seeing more and more funds start to think like, okay, hey, we can still try and make this money available if it's a little bit of tech is built in. And maybe in the future, I don't know, maybe they'll say, maybe no tech at all. But I think, you can understand why tech would be important, because, it helps in efficiencies and optimization, that kind of stuff, which necessarily wouldn't have not necessarily have been there. But that's not to say there's no other funds that are here that are doing what we're doing. There's other funds that do the same. We know funds that have invested in, for example, like in Savannah Brands, we've gotten with a great co-investor into that investment. They do both tech and non-tech investments. Again, angels are writing checks in both tech and non-tech investments. So there's definitely a difference, and I think it goes back to understanding the market, understanding what you need to invest in, and how to invest it makes a big difference.
Cool. Thank you. So, and thank you for staying slightly over here. I'd just like to go out with two quick things. First, I'd love to have from you a word of advice, maybe to entrepreneurs that are getting started, getting ready to pitch investors. What is what are the one or two things that you could tell them in going into that fundraising journey? And then I'd like to leave with a bold prediction on the number of unicorns by 2025. so there you go. Those are the last two.
I'll start with the last one. So far okay. we have 15 portfolio companies. So hopefully at least 15 by 2025.
Okay, great.
all of our portfolio companies. No pressure, guys. But no, I think in terms of like advice to founders and entrepreneurs, we recently did a seminar, funnily enough, an investor readiness seminar with the University of Strathmore here locally, just to like talk to local entrepreneurs and to try and get them to understand young local entrepreneurs. And what we found, which was ironic, and I don't think it'll be the case for everybody, I think, really just understanding the sophistication and the different ways to raise capital, I think that's a really important one. You don't always have to price your company at the beginning. You can use do research on the types of instruments that you can raise capital with, because it helps you to apply sensibility to your fundraising. You can use a note, and you can avoid overpricing or underpricing your company. You can avoid diluting yourself too much, or forcing investors to look somewhere else. So really just understanding how to raise capital, and that it's not just debt and it's not just equity. There's different ways to do it. I think that's, funnily enough, something that we've seen a lot of people miss at the start of their journeys. So that's one. I think I'll always say to everybody, patience is another important one. But, and then I think you should always know when you're raising. So if you've already got a company and you have some cash in the bank, and your burn rate, and when your cash is going to finish, make sure that you're raising before your runway is like at an alarming levels. Like you need to set targets in advance and be like, what, when we have 6 months worth of runway, I will start raising money. Maybe that's cutting it close, depending on your business model. Maybe it's not. Right? Maybe your business is super great, and investors can do it according to Boom on Zoom calls in one day. I don't know, but just know when you need to raise money and when it's going to become tight. I think resilience is super important, for you and for your businesses, like making sure your cash flow is resilient to all what we've seen has happened in the last 2 years. So discipline is super important, resilience is super important. And lastly, I think just do your due diligence. I think it's super important to find the right investors. Think about the value that that investor would bring to you. Don't just take money because you need money. Sometimes you can do that, which is fine, but it's not a bad thing to make then your investors, also work with their investment. Like they should want to help their money grow, right? So find the right types of partners and really just, spend your time identifying them and then forming good relationships with them. Be open to criticism. That's again another important one. And then good luck.
Yeah, thank you very much for sharing that. Just to really put an asterisk, it is not according to Boom. I'm not setting an
I know,
expectation to raise
Disclaimer.
disclaimer here. I am not setting an expectation
When
to
Boom
raise in
sets
a
up
day.
his own fund, the criteria is just have a Zoom call. That's it. You don't even need a business. You just need a 1 hour Zoom
You
call.
get
with
money.
Boom.
You get
You
money.
get
You
money.
get money. I wonder if I'm gonna have any LPs back me on that. But but
Probably
hey,
need to delete
Hamza,
this video before you try and open a fund.
clip the last end. But Hamza, yo, it's been really, really fun. Thank you very much for making the time and staying over with all the people in the audience. And yeah, so for all the entrepreneurs that followed this, you heard it. The best way to reach out to Chandaria Capitals on their website, and you could kind of fill out your form there. And any parting words, Hamza?
I think we covered it. I think just probably a shout out to you and what you guys are doing. I think it's great to be focusing on entrepreneurs and both high and low touch. I think that's really important. I think again, another important place where we've seen evolution is accelerators and incubators and the type of help that startups are getting. I think it's definitely improved. I think people should reach out to guys like Boom and just take advantage of the information and the resource and the help that's out there. I think it's great, and I think you guys are doing a pretty good job.
Thank you very much, Hamza, for that vote of confidence, and thank you for making the time. Thank you, everybody. This was Let's Talk Startups. Excuse me? Oh no, that's fine. That's fine. That's fine. We're able to put in a few commercial breaks. I think the audience enjoyed it. Thank you. This was Let's Talk Startups in Africa, episode 10 with Hamza from Chandaria Capital. And see you next time. Bye-bye.